All right, so we're now into the third and final section of this lecture, and we had just gotten finished talking about the poverty estimates and how they compare across time and across different national contexts, so as to help us better understand the extent of poverty here in the U.S. And so in this section, we're going to take a step back and look at the issue of poverty. And it's not just poverty that we're concerned with. We've noted numerous times up to this point that there are related concerns with poverty. That is, we can address poverty, but of course, we also have to think about the work effort, changes in family structure. There are lots of different concerns here. And so let's just take two of those policy concerns, that is with poverty and then the work effort, right? Two primary concerns that we've been grappling with up to this point. And so as a policy matter, if our concern is primarily with poverty and addressing poverty, what we might consider is to think about the poverty thresholds, and then we count up the resources of the poor. We count up all the resources, and we have a shortfall. We have a difference between the threshold and the amount of resources that that the poor actually hold, and so we could fill that gap, right? So if we're concerned about poverty per se, then we simply provide government assistance in the way of in the amount of the actual poverty gap. But of course, when we do that, when we're too generous in the way of government assistance, there's of course the concern about incentives for work. As we've pointed out, people might work less because they know they're going to get assistance up to the poverty level. And so on the flip side, we might have a concern about the work effort or dependency or reliance on government assistance. And if that's our concern, if our primary concern was with reliance on government assistance, then of course we could simply just do away with all government programs, and we'd address that issue pretty on a straightforward basis, right? We would just eliminate dependency on government assistance by eliminating all government assistance programs. But of course, the concern here is with addressing poverty and dependency simultaneously. Okay, and so the historical tool that we've used, and this is throughout our poverty policy history, we've used something called an earnings disregard to address both at the same time. And so let me just show you how this tool works. And so we have, let's say we have a family of three. And so we noted in the previous part of this lecture that the threshold for family of three as of 2014 is $18,850, okay, or what comes out to about $1,600 per month. For a family of three, I rounded up, it's about $1,570, but for calculation purposes, let's just round up to $1,600. And so if we have a family of three that's earning $1,000 a month, right? If our concern, once again, to put an example to this, if our concern is with poverty, then we want to fill that gap. And so there's a $600 gap between how much resources this family holds and what we're designating as an absolute poverty threshold of $1,600. And so we could, as a policy matter, we could fill that gap of $600. But of course, this family knows that whatever the gap, the government will make up that gap. And so, of course, we have a concern with reliance on government assistance. And so let's further illuminate this point. We have three families. We have three families with three kids and at three different income levels, annual, or we're talking on a monthly basis here. And so you have a family with no gross earnings, right? And as a policy matter, we want to get that family up to poverty, and so we would be providing $1,600 in the way of government assistance to bring that family up to poverty in the case of the first family. We have a second family that's working, right? The first family didn't work. The second family is in fact working, and they're earning $1,000 a month. We just pointed out that we have a gap of $600, and we could fill that gap. And then we have a third family that's right at the threshold at $1,600. And so there's no gap there. And so as a policy matter, we wouldn't need to do anything. But of course, if we're comparing these three families, the family earning $600 or $1,600, they're working quite hard. And they notice that the family who earns nothing is still receiving $1,600 from the government. And so you might imagine what happens to the work effort. That family says, well, we could work 40 hours a week, get minimum or close to minimum wage. Or we could not work at all and still be up to poverty level. And so you could see how the work effort might go down, and there might be greater reliance on government assistance if we're just concerned about addressing the poverty issue and not necessarily dependency. And so what we've done as a historical matter, historically, is just we're talking about the earnings disregard and how it works here. And so So we have the same three families. Okay, we have the family with no gross earnings. That first family is not going to receive any assistance because they don't have any earnings. And so by definition, when we're talking about an earnings disregard, this only applies if the family does in fact have earnings. And so the tool, just philosophically speaking or conceptually, we're talking about a tool that's supposed to encourage work, right? We're not just addressing poverty, but we're trying to address the related concern about the work effort. And so the earnings disregard, what we do is literally we disregard a certain percentage of earnings. So our very first disregard percentage in the US in the way of welfare policy was 33%. But I'm assuming here, let's implement, hypothetically speaking, a 50% disregard. Okay, we're going to implement a 50% disregard, but this first family is not receiving anything in the way of disregard because they didn't earn anything, and so their total take-home pay will be $1,600. We're going to give that family $1,600 in the way of a government grant, and we've brought that family up to poverty under this new hypothetical program in which we're going to implement the earnings disregard. No earnings disregard, we bring them up to $1,600 in the way of total take-home pay. We have the second family. I recall that the second family earned $1,000. And so by virtue of this earnings disregard, 50%, this hypothetical 50% disregard, we disregard literally 50% of what this family made in the way of monthly earnings. And so we've disregarded, I note here, we've disregarded $500. And so we're left with countable earnings. That is the amount of earnings that we actually count when calculating this family's government grant is also $500. The countable earnings amount is also $500. And so under this hypothetical program in which we're trying to bring everyone up to poverty level and also promoting work at the same time, we're going to give them the maximum grant allowable, which is $1,600 minus countable earnings of $500, in which case we want to give this family $1,100 in the way of a government grant. And so the total take-home pay for the second family would be the initial gross earnings plus the government grant of $1,100, which would net them $2,100 at the end of the month. Right? So this first family took home $1,600. The second family took home $2,100, and you can see, that we've provided a little bit of a boost. This family is a little bit better off than the first family by virtue of this earnings disregard. So another example here, another illustration. You have a family that earns $1,200 here. Right, so we have the 50% disregard. I'm just highlighting the same points. We have a 50% disregard, and so we're disregarding $600 is what I'm pointing out here in assessing or in taking into account their countable earnings. And so their countable earnings, the actual amount of earnings that we're going to consider when we calculate the actual grant amount is also $600. And so the grant is the maximum grant allowable $1,600 minus countable earnings of $600. In which case, this family with $1,200 in gross earnings will get $1,000 in the way of a hypothetical grant. And so if we consider the total take-home pay, we take their initial earnings, $1,200, plus the grant amount of $1,000, and we've made this family a little bit better off than the $1,000 earning family. Right? This family's total take-home pay is $2,200, whereas the $1,000 earning family took home $2,100. Again, by virtue of this earnings disregard, we're trying to provide a boost to their work, not only addressing poverty, but we want to address the work effort, and you can see how this works. And so I'll let you do this example on your own. You have a family of three, once again, with $1,700 of earnings. So you can go through at home and figure what the amount of disregard is, in turn the amount of the countable earnings and the amount of the government grant, and the total take-home pay. Okay. All right. We have another concern though, and so we're thinking big picture. What we do about poverty, and the most notable related concern about dependency or the work effort. And so we have an issue here about where to set the threshold. Okay. And so you'll notice that in this hypothetical, this family is earning $1,700, where the maximum allowable grant we said was $1,600, and so should we provide a grant to this family is the basic question here, right? So as a policy matter, the basic issue is, do we allow families to go above that threshold, that initial threshold of $1,600, or should we cut people off right at $1,600? Okay, and so we have a choice here as a policy matter, and so let's assume that we're going to cut people off right at $1,600. Okay, and so you have a family that's earning $1,500 and $1,599. And so if you go through the calculation of the amount of the disregard, assuming 50% disregard, the amount of the disregard, and assuming countable earnings in the way of, let's see here, countable earnings in the way of $849.50, you'll notice that the grant amount is $850.50, and the total take-home pay is approaching $2,450 for the family that's right beneath that cutoff. But then what we see here, if we're going to implement this cutoff right at $1,600, by earning one additional dollar, a family goes from a grant amount of $850.50 to absolutely nothing, right? So the family that earns $1,599 will take home $850, but the family earning $1,600 receives absolutely nothing. And so what we have is what we call a cliff effect. That is, for earning one additional dollar, we've essentially penalized this family, $850 in the way of grant, and 50 cents also. Okay, and so we have a choice here. Either we cut people off right at the threshold amounts, in which case we would see this cliff effect, this penalty essentially for earning that one additional dollar right at that threshold level, or we allow families to go above the threshold amounts. So in this case, with a 50% disregard, you could earn as much as $3,200, and by virtue of a 50% disregard, you might still qualify for government assistance because you'd have $1,600 of countable earnings with initial earnings of $3,200 by virtue of this earnings disregard. And so given the two choices, as a policy matter, historically, we've chosen the latter option. That is, we allow families in the way of our various public programs to go above that initial eligibility threshold. So we do it in SSI, we do it in TANF, we do it in all our public assistance programs, and that's what we've done historically. Okay, and so that concludes the last part of this lecture.